Welcome back. Very little news to report today, but this week's economic calendar is full, and we find very historic levels on some of these markets we're going to get to in just in a second. Tomorrow alone, we have three different Federal Reserve speakers, existing home sales. Wednesday, S&P PMI, new home sales. Now, Jackson Hole Summit is on Thursday. That's a Federal Reserve President Summit where they talk about a lot, and the entire market is going to be watching what they say. Durable goods is also released, and then Friday, Chairman Powell gives an opening speech again at Jackson Hole. In addition to University of Michigan consumer sentiment, now it's so important that we talk about what these Fed speakers will say because the markets are in such an unusual situation. This is today's change in U.S. Treasuries. All yields across the board are up. Notice the 3, 5, 7, 10, 20-year yields especially are up. These are in basis points, so the 3 years up 7 basis points, the 5 years up 8, so it's a 7 and 10. Now, these moves in and of itself are not significant. However, when you take a look at the current U.S. Treasuries, now, of course, we have an inverted bond market. We have the 1 month note at a 555, the 2 month 553, the 6 month at a 558. Okay, of course, we know this. We've had since last June, over a year, an inverted bond market where the lower maturity treasuries pay a higher yield than the longer term maturities. However, what you'll notice is that the longer term maturities, like the 10-year, is now at a 434. Now, I know this seems lower than the short term. It is. But the long-term treasuries have been skyrocketing, and that's what's so unusual. That's what we have not seen in prior inverted bond market conditions. We'll see a chart in just a second. This is the 1 month percentage change in treasuries. Now, the short-term treasuries, no change. The 1 month note up 2%, if that. Everything else is pretty much flat. The 5 year is up around 7%. The 7 year is up 8%. The 10 year is up in terms of yield alone over 10%. Now, the reason why this is important is because typically what we see in an inverted bond market situation like the current one, with the red line here is a 1 year treasury. The black line is a 1 month note. It's a very short term security, but consider these to be close to each other. They are. This is an inverted bond market where the red line is above the purple line. The purple line is the 10-year bond. Normally, we'd expect a longer term maturity to be higher than the short term, but it's inverted. The white histogram bars, by the way, in the background, that's the S&P 500, which has now been kind of weak for a couple weeks here. Typically, when we have an inverted bond market, we'd expect the inversion to end with the short term crossing down. In prior inverted bond market conditions like 2001 and 2007-8, we saw the short term was above the long term, but then the short term turned down. What we're seeing now, it's very peculiar, is the long term is rallying up in anticipation that the Federal Reserve is going to have higher rates for a longer period of time. That's my opinion. This is what the bond market looked like in 2006. Okay, the purple line is the 10-year. The blue line is a 5-year. The red line is a 1 year. Now take a look at the 1 month note, the very short-term security. We crossed above, that was the inverted bond market. Now, of course, we also had at one point, what we can see here, the red line was above the purple. That's also an inverted bond market. But the real extension here was that the white line, the 1 month, was so far above the 10-year. Well, this is a 2006. Now, of course, we know 2007 and eventually the crash in 08. What happened? The 1 month turned down and crossed back below the 10-year, the longer term maturities. The 1 month follows the stock market closer. It's more reactive because it's a shorter yield, so it's reflecting more of the immediate future, the anticipation of the near term, as opposed to the 10-year, which is the anticipation of the long term. Well, in prior inverted bond markets, the short-term bond was above and it crossed back below. But now we're seeing quite the opposite. Again, what we're seeing is that the 10-year is going up. It's not that the 1 year or the 1 month is going down. The 10 years going up. The 10 years telling us, the bond market's telling us, maybe, we're not going to have a recession. Maybe we're going to have even higher interest rates. I mean, the economic numbers that we've seen recently point to, sustainable inflation. And at the same time, we have a jobs market. Now, I happen not to agree. We talked about the non-farm payroll a couple weeks ago. To us, it seems soft, but according to the Federal Reserve, strong enough to sustain higher interest rates. This is the current federal funds futures reading. The red square or dots or the red circles above indicate the likelihood that the Federal Reserve will keep interest rates unchanged at the 525 to 550 range in the next meeting in September. The blue circles over here represent the probability that the Federal Reserve will raise interest rates again from 550 to 575. Red is where we are right now. Now, you'll notice a couple weeks ago we had construction spending, non-farm payroll. Chances the Federal Reserve was not going to raise interest rates to keep them at the 525 to 550, 87%. Wholesale inventories, 85%, 86%, not big change. Our inflation numbers came out, consumer price index, producer price index, 90% chance the Fed would not raise interest rates. We had the Fed meeting last week, the meeting minutes, I should say, that were released. And that pointed a little bit towards the fact that the Federal Reserve may consider raising interest rates. Well, the bond market and the federal funds futures are watching a whole array of different things. We don't know exactly why these move, but now we see 84.5%. Relatively speaking, going back to early August, this is the lowest probability. I know it's still high, but it's a shift in sentiment. We now have an 84.5% chance the Federal Reserve will keep rates unchanged. We had an 11, now a 15% chance they will raise rates. So the sentiment is shifting. When we revisit this chart on Friday, after Chairman Powell speaks and all the other Fed speakers and the Jackson Hole Summit, which is one of the key events in terms of Fed watchers all year, it'll be very curious. I think what this looks like at the end of the week is going to tell us what the Federal Reserve is most likely going to do in their meeting in September. Now, again, it's a very unusual situation because we did not see at the end of 2001 and 2008 inverted bond market conditions the long-term maturity, in this case the red line, cross up above the short-term, such as the 1 year, the black line. The blue area charts the federal funds future. I'm sorry, no, it's the federal funds interest rates, which are, again, 550 now. We haven't crossed back above, but you can see the gap is narrowing. The red line is going up as opposed to the black line, which is kind of staying pat. Here we see, this is a zoomed in view of the S&P 500. Now, while all of this is happening in the bond market, we've seen 3 weeks of weakness in the stock market. The S&P 500, July, we hit levels around 4,600. Now, the red line is a 20 simple moving average. The yellow line is a 90 simple moving average. These aren't magical numbers, moving average wise, but they are very commonly used. So we watch them as well. Now, the purple histogram bar in the background is the VIX, the volatility index. It measures the premium on those options on the S&P 500 that will expire the soonest. It's also known as a fear gauge. When stocks go down, the VIX goes up. Now, in the past, we've seen the stock market go up, 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 and the VIX has remained below 20, especially lately. It's been contained below 17. We're right around 17 right now. And as the stock market comes down, it hasn't yet tested, but we're coming closer to the 90 simple moving average. All the traders out there are asking themselves a question. Are we going to hold at 90 simple moving average, and will the VIX stay below 20? If the VIX crosses above 20 and we cross below the 90 simple moving average, which my guess is may coincide more or less. Keep those two numbers in mind, by the way. The 90 simple moving average on the S&P 500. You can also watch the Dow or the NASDAQ. They're all going to be pretty similar. And the VIX below 20. Those two levels I think are very important to watch. Now, this is where we are this week in terms of VIX today, beginning of the week. VIX 1730. Last week we had a VIX at 1789 on the close. The red line is the S&P 500. So when the stock market goes down, the VIX goes up. 17 is not 20, but lately we haven't seen VIX above 17 in a while. By the way, historically speaking, these are the average returns. Now, the black dotted line is a 90-day average, which is around 3%. Now, if you annualize that out for the year, 3% a quarter every 90 days for the year is around 12%. Well, that's what we expect the S&P 500 historically to return, 10, 12% on average. When we see, for example, the green histogram bar, this is the way we read it. These numbers at the bottom, those are VIX levels. When the VIX is at 15, we expect a 90-day return around 3% or so. When the VIX is around 20, right over here, we expect the 90-day return over the next 3 months. Let's say you buy the stock market every time the VIX hits 20. Historically, you're going to get around 20% return. Why? Because when the VIX hits 20, it means the stock market's weak. And when the stock market's weak, when we buy it, it goes up more. So when the VIX hits 25 and then we decide to buy it, we get even better returns. Obviously, if we see levels where the VIX hits 35, 40 and above, we would expect 90-day returns to be far superior. But 40 on the VIX, you're only going to see 40 in the VIX after a stock market crash. Typically, majority of the time, you're going to see the VIX below 20. So when the VIX is very close to 20, it means it's one of those bull market rallies that's pulled back and a lot of traders are stepping in. And again, by the way, this is a 90-day forward performance of the S&P 500 when the stock market crosses below its certain whatever moving average. When, for example, the stock market, the S&P 500 crosses below its 10 simple moving average, historically speaking, that the 90-day forward performance, meaning how much money can I expect to make historically speaking over the next 90 days? Well, around 4.4% on the 10 simple moving average. If you wait for the S&P 500 to cross below the 20, historically you'd make around 4.7%. When the S&P 500 crosses below 90 and then you decide to buy, historically speaking over the next 90 days, this is what the data suggests, that we make a little over 5%. Well, of course, this doesn't happen all year long. But if you wait for those moments to buy the S&P 500 when it crosses below its 90 simple moving average, historically speaking, we make around 5% a quarter. Well, 5% a quarter is 20% for the year. Far superior than the expected 12% historical average of the S&P 500. Point being is that we're approaching the 90-day. This doesn't mean we're going to bounce or we're going to cross below. But statistically speaking, when we touch the 90-day, we expect superior returns afterwards. And again, the black line here is the S&P 500, and we can see we've crossed below the red line, the 10 simple moving average. We've crossed below the purple, the 20 simple moving average, which, by the way, from May through present day, well, May through July, 3 strong months. If you buy near these two moving averages, we did pretty well. The 50 is the yellow, the 90 is down here. We haven't touched a 90 simple moving average since March, wintertime. So that's how significant this pullback is. It doesn't mean, again, what's going to happen. And of course, if we have a stock market crash, it will touch the 90 and then it'll go a lot more. So this does not forecast what's going to happen. But it does, we hope, demonstrate that we're in a pretty unusual situation here. Again, moving forward, tomorrow, Fed President Barkin, Chicago Fed Goolsbee, Fed Governor Bauman speaks. We have a Fed officials interview, Jackson Hole Summit. That's on Thursday and Friday. Of course, we have new home sales, S&P services, existing home sales, University of Michigan, durable goods. It's actually kind of interesting how many housing numbers are going to coincide with these Fed speakers. What to look out for? We want to see how aggressive. There's a lot of analysts that are saying, well, Chairman Powell, for example, he's the most important, of course. If he's more aggressive in his rhetoric and he's going to say, well, yeah, no, we're going to fight inflation. We're hawks. We're steadfast in fighting inflation. The jobs market looks good. Inflation is still on the rise. Well, then we expect higher interest rates. I'd expect the longer term bonds to continue to rally higher, maybe the short term bonds even to catch up. Um, and stocks, well, it's anyone's guess. What do you think? I mean, the anticipation of higher interest rates. So far, the stock market's like that. The stock market said, hey, higher interest rates means the economy is strong. But we will come to a point where the stock market will say, we don't like these higher interest rates. It's making it very difficult and very costly for people to finance and to borrow, etc. So that might ultimately be a negative. And that's, of course, if the Federal Reserve leans towards a more hawkish, a more aggressive stance towards inflation. But again, all that's this week, and we'll be sure to update you along the way with any significant changes along the way. We hope this has been helpful. We look forward to seeing you back soon.